Listen, we're talking about how to leverage relationships. This could be with your attorneys or CPAs, due diligence partners, operators, wherever that may be. Relationships are key. And to the extent you can solve your relationships and develop great ones, you can expand the vision not only of your own, beyond your own limitations, but also create the life you want to create, not for only your business, but also the business that you want to experience. So with that, we've got Tanner back in, and we'll be diving deep into relationships. Now, we've talked a lot about relationships, and clearly, just coming off the conversation with you and Tom, that relationship has gone well. You mentioned you were loyal. I know that matters to relationships, but how do you think about when you bring people to the team, like what is that thinking process? I know there's, like when you build a company culture, like that's important, how they fit into the team. How do you think about it with all the different disciplines?
Yeah, I mean, for instance, like Tom, it's just, when I first met Tom, I think, I don't remember how many attorneys we interviewed that were in this space, but let's say that it was close to 5. And so we had prepared a series of questions of, deal structures, experience, basically all of that stuff. And so for us, we really liked his tax, knowledge. So that was, he's been fantastic. Same with the CPA. And then same if you transfer it all the way over to the management company and the way that we have structured that entire company with the same theory of you can have a really big team by having relationships where they're on the payroll, but we're only paying for what we're using specifically. So, attorneys are very expensive, CPAs are very expensive. And it's just trying to be as efficient with the dollars as possible, which obviously, that all flows through back to the investor anyway. So, I think that, again, as I was mentioning, we would originally, I wanted to have this huge, company and everybody in-house. But this has worked really, really well. And it almost, not that Tom doesn't have to compete for my business. We're way past that. But whether we do that with our marketing vendors or, on a certain property, we talk about on relationships on our management side that, hey, you have this property. If we had our own in-house marketing department per se, you would be getting the same ideas, the same things that you would be getting blanketed. But now what we can do is we can bring in, 6 different marketing companies, all who have a different angle. They're going to pitch on your business, right? And so that's one of the things we've started doing for some of our clients on the operating side is we bring those relationships so that they can create their own relationships. But it creates a very competitive environment, and ultimately the property and the customer win.
Yeah, and just like you mentioned, growth is not about necessarily headcount. It's more about either business growth through cash flow or the results, and that's different for every company. It also, does it give you a competitive advantage to sort of like go like this too, like in and outside of a market, like even on accounting, like if you wanted to ramp up and you had a deal and it's 5,000 units and you could take it down, well, if you were handling all that, like you'd have to think through, okay, I've got a new office space, more cubicle, all that stuff. Do you think through that in terms of as a competitive advantage in those relationships?
Yeah, I think the biggest competitive advantage is that it allows everyone to do what they're good at, right? So I'm not focused on the legal or on the operating side, because we can scale up and add, 5,000 units in a week with the back end office, or we could scale down and the company maintains the same level of margin. That means that all of our, fair housing and all the stuff is already in place there. So we're not focused on that. So what we get to focus on is on the property level on the management level being structured that way is we get to focus on what we like to do. And that's having, working with our managers, leasing apartments, so, and I think that our managers now, because even though their job scope is perhaps a little bit bigger, it allows them to be a little more hyper-focused most of the time on what's important. That's, leasing apartments.
Yeah, and at the top of the show, I talked about the who, not the how. And as operators, we tend to try and we've seen expense. We're like, oh, we can do that. We can bring that in and now become the how, but not really. Like it's just like a bolt on to something. Like the focus becomes shifting, and you end up trying to do too much, and we get out over our skis a little bit. So, do you see that? Do you see benefit? I mean, obviously you do see benefit. Otherwise, you wouldn't be doing it. You mentioned like at first it was this way, and now it's like this is working well. Do you see benefit in hiring the who that knows the how, versus trying to become sort of the expert?
Yeah, for sure. Like you can. That's the only way you can buy experience, right? Is to partner with them.
Yeah.
So. Same thing with my GC partners. Same thing, even to the broker level, right? There's so many different brokers have different niches within the market, right? Very rarely there's a few, but very rarely do you have a broker, specifically in multifamily, I've never experienced a co-broke, right? So the broker that gets the listing is the broker that's going to sell it. So when you're buying a multifamily property, you have to remember, odds are like that broker is loyal to the seller. That's in theory where he's getting paid. You do not have any representation, for yourself, which is unlike typically any other, housing transaction where maybe you can have a buy sell, broker or what have you. So, brokers are that as each broker gets in with their specific niche, we have relationships in all of those. And sometimes, we're not a player in that specific niche at the time, but we want to maintain that relationship for if that market changes.
Yeah. And those brokers give you intel that go beyond, well, not going beyond, I guess, what an internal team can provide. It's not always easy to develop those relationships. What's the expectation on the time it takes for a new investor or a new sponsor, syndicator to sort of be that? Is it the money? Is it the track record? Is it just, look, someday I've got these things in place? How do you move that relationship forward? Because everyone's busy.
Well, and I think it depends on the size. So if somebody just says, hey, I want to go buy apartments, I'm doing the apartment syndication and buy 200 units, Class B or Class A right now in Phoenix, it's going to be really hard to get a broker's attention if he doesn't already know you, right? They'll
find you.
They have a plethora of buyers, right? It's
right.
It's a seller's market right now. So, but if you're new and you're wanting to buy 20 units, there's brokers out there that specialize in that. And so it's just understanding what you're trying to do and what your capabilities are. If you've established some credibility, maybe with a lender, with whoever you're going to borrow your debt from, maybe that could help you with the broker. But again, if you're just going to, hey, I'm going to go be an apartment syndicator and I'm going to go look for 200 unit apartments, odds are that the guys in town, the deal you're looking at, have seen weeks, perhaps months in advance, and there's some reason they passed. So that was always, when I first got started, that was the difficult, uneasy feeling of why am I seeing this? Why? Because the broker is going to be loyal to the customer that has bought a lot of deals from him, and rightfully so.
Naturally. Right.
So it's just more work and takes more time. That's all.
Yeah, be patient with that. Speaking of Class B properties, let's talk a little bit about the future of Class B. We talked a little bit about it yesterday. How do you see? Sometimes we take on language, and even real estate terms. I mean, a property is really a property, right? Who lives there? Like, what defines Class B to you? And how do you see it?
Yeah, I would say, immediately where my mind goes would be like a 80s, early 90s vintage, that still has a lot of original elements that, whether it's countertops, cabinets, paint, whatever, that somebody could come in and freshen up, just bring more current. So my mind immediately goes there. We have spent a lot of time internally talking about, we see this influx. Rents are going up so fast. John alluded to it yesterday, what they're seeing on the portfolio. We're seeing the exact same thing where we're getting rent increases without spending necessarily the CapEx dollars. And what's happening is these Class B residents, they're getting pushed. They're getting priced out. They're getting, and I saw in the earlier session when you're talking about, income households, where you lose 4 million, they've lost their buying power. Well,
right.
We're going to see the same thing in the Class B, right? We're raising rents. They're falling out, and where are they going now? So where are those properties? And I think that's a really unique, perhaps, opportunity as far as an affordability standpoint.
Yeah, and you were talking yesterday about cap rates on B, right, being even more aggressive on A. And part of that, is that because there's more money chasing there? And at what point could that number could change? Right? That's not an operating thing, right? So that capital could shift, and then all of a sudden Class B is in a different situation? Or?
Yeah, I mean, so if you look back at like a year ago where the big money was going, so let's say that they went out and they raised a fund and they put parameters around the fund of what they can buy that checks the box. What has changed is now that they can underwrite the value of what they think they're going to get before they get there. So the reason Class B cap rates are trading below Class A is because they're underwriting the future value, meaning I'll buy this for a 3.25 cap, but by doing these changes, we're going to increase their revenue, and we think it's going to be a 4 cap and fit more in the market. And so they're going to pay you. They're going to pay you a little bit for the growth without doing the work, type thing. So great when you want to sell, very frustrating when you want to buy, because you're like, I have to take the risk, put the capital in, and pay you for the value I may or may not be able to achieve. So
along the way.
Along the way. So if I'm going to go put washer dryers in and can increase rents $40, well, they're going to tie a cap rate to some of that growth.
I remember you're saying you're underwrite with a lower cap rate on the
right
going in, but
but it's again, then the people that have these pools of money that are paid to place money, they can buy that, they can underwrite that because their funds, their parameters can underwrite that type of market risk. So that just allows them to push more money in, compress cap rates, and I mean, you have a lot of properties that are trading that are just they're bidding wars. There'll be 15 offers on the property. They'll go into best and final. The buyer you're negotiating against yourself. You're raising your price even more against a number you don't even know, and then you're hoping that you are awarded the property. It's wild. It's a wild model, but it's the way it is right now.
Where do you see the whole amenity conversation? You heard from earlier today, we had single-family homes, build to rent, conversation about residents not needing necessarily the amenities, but they want the patio, the ability to have a dog door, things like that. In Class B, what do you see the amenities? Are there innovations that you're either executing now, I know you said washer and dryers, obviously that's a base level need, but are you seeing any trends in that?
Yeah, I mean, some of the Class B properties are located really well, because
that helps.
They've been around for a long time. So you can check a big location box. So from an amenity standpoint, I would often say it's just really the freshening up. So you might have Formica countertops, so you might move to a quartz or a granite. You oftentimes will have black or white appliances. You might move to stainless steel, like that's pretty low hanging fruit. We have a deal up in North Scottsdale that almost all of the interiors, flooring, everything is there. Things are going so well now. We're thinking about actually scraping the ceilings, but then you have asbestos to deal with because of the year it was built, and so that's a very expensive venture on doing that the correct way. But texture on the walls, you can smooth them and just make them freshen up. One of the properties you were familiar with, the Winfield down there in Scottsdale, which was built in 1965, at the end, besides that it had concrete bones, it was extremely modern. So people would have never guessed.
And it had the location check.
The location was the big check. And so what happens, we had people that wanted to be there. Once we made it feel not as old and hip, and it fit a different demographic.
It was like a find almost.
Yeah, and people were willing to pay for it. So Now you can over improve Class B properties as well. You'll see that too, again, because at the forefront of my mind.
You look for someone to do parking lots, carports, and roofs, and the heavy lifting that doesn't go along with rent increases. Residents don't want to pay for that stuff. But
right, that's just expected. That's status quo. Like the parking lot is my least favorite
colors,
thing to do.
Operating decisions like you had bikes out there and you did some interesting things to innovate the community value add without spending. So the things that people would pay for. I saw you do some of that.
Yeah, I think gyms are extremely important now. I think we'll see those continue to get bigger and bigger. But I'm not for me, when we develop the clubhouse, I'm not a big guy or a big believer that we're going to go build a space that people can rent and bring family in and cook pizzas in and have a birthday party at their multifamily project. So
it's often underutilized.
Yeah, so we really want to design our clubhouses that each space has a very unique purpose. It's highly efficient. And we'd rather take those dollars on an amenity such as maybe a bigger pool, nicer gym equipment, that type of thing. So, and in the 80s, oftentimes you inherit those big clubhouses with those big spaces with, 4 ovens that get used once a year. So.
Very cool. Well, we're going to be right back with you for more. We'll be talking a little bit more later with you, Tanner, on the investment pro forma pitfalls that we're talking about, and then even fee transparency and deals. So I'm excited to continue this conversation. And next, we have some really cool apartment innovation around finance or the cash flow and collections. And oftentimes people they think apartment innovations, they think of how to get the resident in. And so now we're talking about some innovation that I think pays true to what you're trying to do is the economic impact of true innovation.